That's because of the staking cycle and how the charts look, and using the log chart, extending it forwards, and a number of things give me that. It's not my base case. My base case would be 20,000 ETH by March at the latest.
Yeah,
I think the ratio is changing, and it's going to go to something significantly different than. So if it's 12 now, it probably goes to 7, 6. So I think that's what that ETH Bitcoin chart is telling me. So I think that relationship's going to shift over time. ETH's dominance, like Bitcoin's dominance, will fall over time because new technology comes into the space and they solve different problems, and they have different orders of centralization versus decentralization as trade-offs. And that's absolutely fine. I think the flippening has not a high probability, a decent probability.
Yeah.
In the next 9 months. I think that Solana will outperform ETH in this cycle.
Yep.
And I think that Terra will outperform ETH. I actually still see ETH potentially, the small probability upside is that it hits 40,000 by the summer. I'm a crypto maximalist. I totally believe that this is the future of all digital value. I think almost everybody in finance now understands there's something very big going on, and there's a general panic to get out of finance and into this new world. I mean, I get hit up by, everybody from partners of Goldman to asset managers to everybody saying, how do we move to this world? So I think the force is unstoppable. It's the time that's unknowable. But as we know with exponential trends, they always feel slow, and then you look back and suddenly everything has moved. If you think of the exponentiality of what's happened in the digital asset market since, I went irresponsibly long back in, April, March 2020, right? That was a Bitcoin-only world. Yes, other people were involved in other stuff. But then NFTs, DeFi, social tokens, DAOs exploded. This had all been around, and they were like, no growth, like this. And that's what's happening here. I don't know anybody in the financial space who's now not looking to get involved in some way, shape, or form. I've spoken to the biggest private equity firms in the world, the biggest asset management firms, the biggest banks, everybody. I've given presentations, endless presentations to, investment committees, boards, everybody about all of this stuff.
Do you think the recent volatility, downturn in prices, changes any of that, or at this point everybody's past worrying about that?
I think everyone now realizes it's a feature and not a bug, that you don't get exponential upside without high volatility. It's just that's how risk reward works. And the question is do you get compensated for the risk with the reward? And the 50% pullback versus the multiple 100% upsides you get over periods of time shows that time and time again it is well compensated for. So I see no change at all in the number of queries and who I'm presenting to about this. I don't think any of these big investors even care about this volatility, because they need a volatile asset as well in this world, because bonds and other stuff are just non-volatile assets and they can't generate returns, and they've got pensioners who need to reach a hurdle rate and they ain't going to do it in bonds. So they have to take risks. They understand that. And also they're learning that there is more alpha in this space than there is in traditional markets because there's less capital in it. I mean, I don't know, it's probably a trade secret, but it'd be very interesting to go and ask your trading floor the returns of the crypto traders versus traditional markets traders, in various strategies.
Right, yeah.
My guess is crypto has a lot more alpha for a similar unit of risk. And also think about the sheer number of tokens, protocols, all of this stuff that's going to get even harder when it comes to social tokens and sports teams and pop stars and brands get involved. Now we've got NFTs, hundreds of thousands of these things, right? So you've got an exponential growing number of assets. The capital going to the space is not exponentially growing to catch up with it. The complexity of the products, like DeFi, is going exponential. So all that looks to me like that's alpha everywhere, all over that ecosystem. And the capital cannot grow fast enough to arbitrage away the alpha. That's why this whole thing is what we're talking about, is because that is why the magic is there.
Absolutely. It creates a ton of opportunity for a ton of people. It's a fantastic time to get into this market, because it's big enough to be real, but it's also small enough that it's still wildly inefficient in some ways.
And that's why, going back to where we started this conversation, tokenizing asset management in its various guises, whether it's centralized, decentralized, individual traders, pools of funds, DAO structures, that makes total sense in a world where the number of opportunities is going exponential. You need to scale. I mean, you're simply not going to scale a hedge fund strategy like Millennium or somebody of that sort in the traditional world to manage crypto. You have to think differently. You're going to have to think broader, and you're going to have to think further out the risk curve and where you're sourcing your returns in terms of the kinds of traders you go to. So, it really is a revolution going on, and it's super exciting. And I think a lot of people, even listening to this, haven't really yet figured out how big this is and how much is about to change. But everything's going to change. I think it applies everywhere because it's this DAO idea, really, where you put a like-minded group of people around a particular problem and ask them to solve it, which is exactly what that Super Forecaster's book was about. And basically, they will have a higher chance of solving it, particularly if they can discuss with each other how they're trying to solve it. So I think it will apply to anything, from single stocks to macro to crypto to VC to art investing to anything. And we've seen the rise of things like the Flamingo DAO that's starting to prove it out. Now, it's too early days to see how well this works, which communities are good, which ones aren't, because it's going to be about the quality of the community, really, and a long enough track record.
What will that mean for folks like me, VCs, investors, hedge funds? What does that mean for the traditional institutions in this space?
I think the traditional institutions remain because of how they operate within the space, the sources of capital, and how actually investors want a one-on-one relationship with the VC investor. But my guess is you will be a part of multiple DAOs in due course, where you are one of the people involved in that DAO, and that's how you'll think of your VC portfolios is, we've got 20 DAOs that we're investing in, that we're part of the discussion, where we're pooling together with other smart people. The Delphi guys are in this DAO, and Andreessen Horowitz are in this DAO, and we're all trying to solve this particular thing, and that's what we're investing in. And then you'll have your own portfolio of other opportunities that don't have this kind of shared structure, because sometimes it's your own view, and you want to back your own view. So I think it's going to be a hybrid, but what it does change is the economics of the industry, because it's so much easier to do via a DAO structure than it is via a fund structure. It does feel like there's a total disruption of the asset management industry that started. It's really early, but it's starting. Because the speed, index funds, the speed of which you can do that in a kind of new Web3 enabled platform is dramatically different. How you can build like Millennium, which is a hedge fund of multiple different fund managers. Well, platforms like Enzyme create the ability to do that decentralized. So therefore, you as an investor could invest across a whole bunch of different strategies and different people, of which it was not available to you before, whether it's accredited investor rules or just discoverability of finding these people. But with this kind of open Web3, you could scrape all of the data, look for signals on which managers you think you can be your own risk manager. Okay, that's really, really interesting. It's not easy, but my guess is, people like Jump will have a team of people looking at independent traders operating on these Web3 platforms and backing them too. Because why wouldn't they? And why would Millennium not do the same? And why would Brevin Howard not do the same? They all will in the end.